We are going to cover two accounting standards. Can you just move up your eye? She's hiding. I'm unable to see you. AS10 and AS26 is planned. AS10 is an accounting standard on PPE, fixed assets, property, plant, and equipment. When it comes to this accounting standard, we learn any accounting standard from the viewpoint of the following. First one, objective. Second one is scope. Thereafter, we learn about recognition principles, measurement, presentation, and disclosure. Any accounting standard, the body of any accounting standard will have these things. Starting with PPE, objective of the standard. The standard tells you what accounting treatment needs to be done for PPE. Okay. Beginning with AS10, I will restart the whole thing again. We are going to discuss about PPE, property, plant, and equipment. Don't mind about the handwriting, it is coming really bad. We will understand quickly the objective before we start discussing about the scope, recognition, measurement principles. Objective is this accounting standard teaches us how to account for PPE. When I tell account for PPE, we need to understand what does PPE mean. Property, plant, and equipment can be defined as, first word used in the standard is, it can be defined as they are tangible items. Any tangible item, will all tangible items be called as PPE? That's the question. Tangible items means anything that you can touch, see, feel, all that is called tangible. But just because it is tangible, can you call it as PP? Answer is no. You need to check what is the intention of holding that item. Intention. Intention of holding the item. If the intention is if the intention is to use the item, we will call it by something. If the intention is to sell the item, we will call it something. And if the intention is to earn income by way of interest or dividend, we will call it by something. Remember, any item, if you are holding it with the intention of using it, we will call that as property, plant, and equipment. Any asset, if your intention is not to use but to sell it off, what will that asset be called? It will be called as inventory. All our assets, based on what is the intention of having that asset, we will call it by different names. If the intention is to earn income by way of interest or dividend, that asset we will call it as investment. All of these are assets. We classify assets based on the intention of usage. Today's class, we are going to cover the assets that are held for using. That is under discussion. And there are two assets which you hold for using. One is one is PPE and the other is intangible assets. PPE are tangible items that are held for three purposes are mentioned. Held for producing goods, providing services. Can you complete? Can someone complete it? Can we have someone online? Jyotika, can you complete it, Jyotika? Held for producing goods, providing services, rental to others. Okay, she's not talking. Rental to others or for administrative purposes. So PP is any tangible item that is held for producing goods, providing services, or giving it or rental to others, admin purposes. There are two conditions for any asset to qualify as PPE. One is this. The other condition is it should be used. I will tell expected to be used for a period of more than 12 months. If these two conditions are satisfied, that item is going to be called as property, plant and equipment. This accounting standard does not cover three assets. Three category of assets are not covered by the standard. That's what is told in scope. The first item which is excluded from the standard is biological assets. When I tell biological assets, it means any living plant or animal are called as biological assets. Biological assets are totally excluded from the standard. AS10 does not cover it. Next, wasting assets are also not covered by the standard. By wasting assets, I mean coal mines, any mines, quarries which has natural resources or oil resources are called as wasting assets. AS10 does not apply to that. And any other asset which is covered by any other accounting standard is also not covered by the standard, by this AS10. Third one will be assets covered by other standards. Will also not be covered by this standard. So these three standards are excluded from AS10. AS10 applies to bearer plants. I told you that AS10 does not apply to three categories of assets. Can you repeat it? First one? Biological assets, wasting assets, assets covered by any other standard. Now, when I tell biological assets, I told it is biological asset means any plant or animal. There is an exception to that. If it is a bearer plant, it will be covered by AS10. All other plants not covered by AS10. What is a bearer plant? A plant that will give you benefit for more than 12 months. Easy way to put it. When I tell bearer plant, this is a plant that bears produce. The best example for bearer plant, you can take it as mango tree. If I'm having a mango tree, am I having this tree to cut the tree and sell it off? No. The purpose of having mango tree is whatever fruits I get on the mango tree, that will be called as agricultural produce. The purpose of holding the bearer plant is to sell the agricultural produce, but not to sell the plant as such. For how many years am I going to use this mango tree or this bearer plant means it should be expected to be used for more than 12 months. And there is a very, very remote chance that I will cut the plant and sell it off as such. For example, if I take banana tree, if I'm having banana tree, after I harvest once, will I get banana from the same tree again? No, I will have to cut it off. Will that be a bearer plant? No. Coconut tree, is that a bearer plant? Yes. So bearer plant definition is there in the book. If you want, you can refer to, but I wanted only you to understand the meaning of bearer plant. Okay. Now I have talked about the scope. We have learnt Definition: PP are tangible items that are held for producing goods, providing services, held for rental to others or for administrative purposes, and it is expected to be used for more than 12 months. Scope we have discussed. Now we will enter into recognition principles. Recognition principles are two. First one, it is expected that, I will just talk about it. I'm unable to write this anything comfortably. It is expected that future, it is, or I will change this thing. It is probable that, write down, no, as I tell, if you want to write down, it is probable that FEB, future economic benefits, will flow to the entity. And second one, cost can be measured reliably. It is probable that FEB will flow to the entity, cost can be measured reliably. These are the two recognition criteria. I will speak about measurement criteria and then we will take up a question to do. Just open space of questions. Okay, can you turn to page number 20? A Limited has entered into a binding agreement with Gamma Limited to buy a custom-made machine for 1 lakh rupees. At the end of 2021-22, before delivery of the machine, A Limited had to change its method of production. This new method will not require the machine that has been ordered, and it has to be scrapped after delivery. Scrap value is nil. You are required to advise the accounting treatment for this. Now they have purchased a machine. Machine represents a PPE because it is a tangible item. It is held for producing goods and it is expected to be used for more than 12 months. It is a PPE. But does it satisfy the recognition criteria of PPE? We need to check before we recognize that as an asset in the books. What are the two criteria? It is probable that FEB will flow to the entity. Cost can be measured reliably. Is there a probability that FEB will flow to the entity? Yes or no? No. Why? Which sentence tells that? New method will not require the machine ordered and it has to be scrapped after delivery. The scrap value is nil. So are you going to get any benefit out of this? No. Can you recognize that as an asset in the books? No. It has to be written off. Okay. We have to decide on the journal entry. I repeat, recognition criteria has to be met in order to capitalize an expenditure. Any money spent is called as an expenditure. This expenditure, if it meets the definition, the recognition criteria, it will go as an asset in the books. If it does not meet the recognition criteria, it will go to P&L as an expense. In this case, it does not meet the criteria, it will go to P&L as an expense. The journal entry for this will be, we will have to debit the loss. On one side, we have purchased an item, but it is of no use to us. Just because it is of no use, can we tell the supplier that I will not pay you money? We have to pay the money. So we have to create a liability to pay that person. Whoever is that supplier, we have to create the liability to pay Gamma Limited. This Gamma Limited will have to create a liability to pay. Journal entry will be loss to Gamma Limited. Ultimately, the loss will be transferred to P&L. So the recognition criteria, I just wanted to do a question on that. Now, moving back to the standard. Next comes about measurement. When I talk about measurement, there are two things. In two parts we're going to discuss. First part is initial measurement and then it is subsequent measurement. When at an initial measurement, we are talking about initial costs that are incurred. How are we going to measure it? Subsequent measurement, we will deal with costs that are incurred later. Cost 2, I will complete it later. I will talk about it afterwards. Initial cost means cost that you incur at the time of purchasing an item, acquisition cost. How are we to measure the cost? What and all components form part of cost is, first is purchase price plus any non-refundable taxes, which means any GST or customs duty for which you cannot take credit. That item we'll have to add it to cost. If you can take credit, it will not be included in this. Minus any trade discount. This is the first part of the components. Next, plus any directly attributable expenses should be added. There is one more item to be included in this, and that is, right now I have installed the plant and machinery in my factory and we are using it. After 6 years are over, we'll have to dismantle the machinery and then only I can sell it off. We have to dismantle or we have to decommission the item. There is a factory premises. In this factory premises, we have set up a machinery. Let's take to manufacture matchsticks. To manufacture matchsticks. When the matchsticks are getting manufactured, the machinery, it needs to be commissioned or fixed in a place. There is some setup installation costs that are incurred and set it up there. When 6-7 years are over and I have to sell the machinery, I have to dismantle it and then sell it. For dismantling, I have to incur, let's take around 30,000 rupees after 7 years. That should also form part of cost. Dismantling and restoration cost will also form part of cost. Only point to be noted here is this 30,000 will be incurred after 7 years. So if I have to include it in cost, now I'll have to find out the present value of this and then only include it. Present value, how to determine? Financial management teaches you that you'll have to do discounting procedure to find out the present value. Total of this will give you the cost of PPE. Let us take up a question and solve for this under this model. Question number 6 we will try. Shrishti contracted with a supplier to purchase machine which is to be installed in his department A in 3 months' time. Special foundations were required for the machinery which were to be prepared within this supply lead time. The cost of the site preparation and laying foundations were 1,41,870. These activities were supervised by a technician during the entire period who was employed for this purpose of 45,000 per month. So far what we have read is they have purchased a machine which is to be installed and that will take 3 months time. Special foundations were required. Cost of that foundation is so much. This is the first cost identified. Then there is a technician which is who is employed. Per month he has to be paid 45,000. How many months of service we will need of this? 3 months. So into 3 we'll have to do. Can we just keep adding in the calculator? 141 m plus, we'll put it in the memory. Then 45,000 into 3. Thereafter, the technician services were given by Department B to Department A, which billed the services at 49,500 per month after adding 10% profit margin. Will you include the internal profit margin into the cost? No. So are you going to take 45,000 or 49,500? 45,000 only. Into 3, done. We have put it in M plus. Machine was purchased at 158,34,000 inclusive of IGST 12% for which input credit is available. So can you find out excluding GST value? 158,34,000 divided by 112. It is inclusive, so it will divide by 112 into 100. You will get the cost excluding GST. What is that value? 141,37500. Put it in M plus. Transportation charges 55,770 M plus. Architect appointed at a fee of 30,000 to supervise. Even that 30,000, can you include it in the cost? Can you include it? Yes, you will include it. Okay. Done. Please press MRC. Tell me what is the answer you're getting. Are you getting this? 145,00140. Yes, this should be the cost. We've added all the components. In this question, there is no cost which we have excluded. Everything is relevant for us. This is the way the answer needs to be presented. Okay. This is from the very recent RTP, May 25. Moving to this question, Neon Enterprise operates a major chain of restaurants located in different cities. The company has acquired a new restaurant located at Chandigarh. The new restaurant requires significant renovation expenditure. Management expects that the renovation will last for 3 months, during which restaurant will be closed. Management has prepared the following budget for this period. Salaries engaged in preparation of restaurant before its opening, construction and remodeling cost of restaurant, 30 lakhs. Explain the treatment of these expenditures as per the provisions. There are two costs mentioned in this. One is 7,50,000, which is cost of opening. Salaries paid to staff or before its opening, and construction remodeling cost of 30 lakhs. Can both of it be capitalized as PPE? Answer is only 30 lakhs can be capitalized. The salary that you're paying to the staff in preparing the restaurant before its opening is like inauguration cost. There are certain costs which should not form part of PPE, and they are as follows. I will list down what all should not form part of PPE now. Costs that are excluded from PPE are, first one, inauguration expenses, inauguration cost. Second one, any promotional expenses will not be included. Suppose you are launching a product. For purpose of marketing, you're giving some free samples. That cost will not be included in the cost of PPE. Next, general admin expenses. General admin overheads, else I can tell you. The next one is any cost for relocating or reorganizing operations. Relocating the operations temporarily, that cost also will not be included in the cost of PPE. These are the costs which are specifically excluded from PPE. The answer, any cost that is directly attributable to bringing the asset to the location and condition will form part of PPE. They are giving you the provisions first, and then they tell related to the question. It should capitalize the cost of remodeling because they are necessary to bring the restaurant in the condition capable of operating in the. If you don't want to write this sentence, to bring the restaurant for its intended use, that is another way of writing. Instead of writing this provision, capable of being of operating, instead of this you can write it as to bring the restaurant for its intended use. Restaurant cannot be opened without incurring the construction expenses, so 3 lakhs has to be capitalized.
I didn't come last week. Can I not write the example there?
Yeah, sure. Okay.
Thank you.
So you will take it up when, Shrishti, then? 1 week?
Yeah, yes, sir.
So next week, Monday, you will take up?
Yes, sir.
Okay.
Thank you.
Okay, I hope that question is clear. Now coming back to the provisions part. We are done with initial recognition, initial measurement. Initial measurement, I spoke about a PPE that was purchased. Just a minute. If the class is over, I would like to move. There are 3 ways in which you can acquire PPE. One is by payment of cash. Second is it is a self-constructed PPE. And third is we are acquiring the PPE by exchanging another non-monetary asset. Exchanging another PPE, I can take it as. Whatever I told now is where we acquire the PPE by payment of cash. Suppose you self-construct PPE, whatever cost you incurred for constructing that asset will form part of cost. Material, labor, overheads, whatever you incur will form part of cost. There is no question which is tested on self-construction. Suppose you exchange one PPE, you give one PPE and get another PPE. Exchanging, this will be capitalized at fair value. Fair value of what is the question? Say, we have machine 1. We have given this old machine and we have received back a new machine. In that scenario, how do we measure the cost of PPAs? We will record it at fair value of asset given up. Or, see option 1. When I tell fair value of asset given up, let's take we have machinery. As per our books, the book value of this machinery is 4 lakh rupees. I have got another machine by exchanging this machine. At what value are we record when I tell? Am I talking about recording machine 1 in the books or machine 2 in the books? 2, machine 2, because we are looking at what value am I going to capitalize the new asset which I purchased. The new asset which has come, at what price will I record? That will depend on the fair value. Fair value, there are 2 options given by the standard. Option 1, you will record this machine 2 at the fair value of asset that you gave up. Or if this is not available to you, then you will record it at fair value of the asset received, whichever is more clearly evident. This is the provision. There is no question which has been tested on this either. Option 1, fair value of the asset given, or else fair value of the asset received, whichever is more clearly evident. Whichever is you can find out, you will record it at that value. Okay, measurement, initial measurement is done. Next comes subsequent costs. Subsequent costs means costs that are incurred after PPE is put to use. Cost incurred after PPE is put to use. Say we have a machinery. We started using this machinery from the year 2023. After 2 years of usage, we may have to add some parts to this, or we may have to replace any parts to this, or do some servicing. We are going to talk about the recognition and measurement criteria of this. And after you put to use, you're going to do some addition to this asset or replacement or servicing. What will happen to this cost? Are we going to capitalize it, or we will charge it off to P&L? To decide whether to capitalize it or charge off, there is a recognition criteria given by the standard, and that is, we have to check whether this is going to increase the future economic benefits from the asset. Earlier, I was able to manufacture 1 lakh units per annum using this machinery. Per annum, 1 lakh units I was able to manufacture. By doing some modification to the machinery, now I will be able to manufacture 1,20,000 units per annum. Will you capitalize it? Yes. It should give you more benefit than what you had got previously. If that is satisfied, you can capitalize. If it gives you the same benefit, it just helps you maintain the performance, no capitalization, charge it off to P&L. That is the recognition criteria for subsequently incurred costs. How do we measure it? For measurement, we will talk about, we will divide it into 2 types of cost. One is replacement cost and the other I'll come to it. Replacement cost I'll finish off first. Say we are having some machinery with a turbine as one part in this machinery. This turbine is getting replaced. By replacement, the efficiency of the machine will be better. So how do we recognize this replacement cost is, we will be doing it in 2 steps. Step number 1, we will de-recognize. De-recognize means, I can also tell it as remove. I will use the word de-recognize. Remove is just to understand, otherwise the technical word is de-recognize. De-recognize the book value of the old part. De-recognize the old component and recognize the cost of the new component. Let us do a question to understand this. We are going to do question number 7. Jan 25 RTP. MS Limited has acquired a heavy machine at a cost of 1 crore with no breakdown of the component parts. Estimated useful life is 10 years. At the end of the 6th year, one of the major components, the turbine, requires replacement as further maintenance is uneconomical. The remainder of the machine is perfect and is expected to last for the next 4 years. The cost of the new turbine is 45 lakhs. Discounting rate is assumed to be 5%. Can the cost of the new turbine be recognized as an asset, and if so, what treatment should be used? have to decide on the cost of turbine to be recognized now. Turbine cost, what we are dealing with, it is a replacement cost. We are already having turbine included in that 1 crore rupees. Cost of total machinery is 1 crore rupees. Do you have a breakup of the component of this? Means answer is no. The question tells that they do not have a breakup of the components. Are you aware that there is something called component accounting as part of AS10? One full asset. We can break it down into small components also and record it. When can we do component accounting is when, let's take, there is an aeroplane. In this aeroplane, the motor of the aeroplane has a life of 5 years. This body of aeroplane, this outside thing, that has a life of 15 years. And the seats and all in this aeroplane, that has a life of 3 years. In such a scenario where the aeroplane is an asset, but in aeroplane also every component, the different components have different useful life. In that case, we can capitalize this aeroplane as follows. Aeroplane, we can do component 1, motor, useful life of 5 years. We will depreciate the value of motor over 5 years. Second part, the body of aeroplane, we will depreciate it over 15 years. And third one, the seats, we will depreciate it over 3 years. When we are splitting one asset into different components, we are into component accounting. Component accounting is allowed as per the accounting standard. So this question tells there is a machinery with 1 crore is the cost of the machinery. They do not have the component breakup for this machinery. They are going to replace a turbine. After how many years of usage are they replacing the turbine? At the end of the 6th year, which means they have used the asset for 6 years. And they are replacing the turbine. Cost of the turbine is 45 lakhs. Do you know what the cost was of the turbine 6 years back?
But discount rates.
You do not know. But the discounting rate is given. So apply the discount rate and tell me what is the value 6 years before. Can you do the discounting? I will just come back. You do the discounting, I'll just come back. Have you found out the present value? What is the present value you're getting? No idea. What's your name?
Vikram.
Vikram.
33,57,969.
Correct. Yes, correct. Something around this if you get this correct.
33,57,969.
Yeah, 969. Here it is 900. It's okay. How you should be doing it is, you have to find the discounting factor. What is the discounting factor you got?
5%.
5%. You know how to do it, no?
6 years.
1 divided by 1.0. Yeah, 1.05. You have to press equal to 6 times. You will use that discounting factor into that 45 lakhs. So you will get 33,57,900. I will take it for computation purposes. So what you will do with this machinery cost is 1 crore. You will deduct the book value of the old turbine and we will add the cost of new turbine. Now what you told me as 33,57,900, that will be considered as cost of the turbine 6 years back. But what are you to deduct? Book value as on today, which means you'll have to do depreciation. Okay, you cannot deduct 33 lakh directly. To depreciate it, look at the question. What is the useful life that was expected? 10 years. So this, you, in the absence of information, you should always follow straight line method. This, calculate 6 years depreciation for this. It will be divided by 10 into 6. Useful life is 10 years. So for 6 years, how much? You will get 20 lakh 14,740 if you do it in the calculator. So 20 lakh 14,740, we will reduce it from here. You will get book value of the turbine. What is the book value getting? 13 lakh 43,160. Little plus or minus above is okay. You should be getting this. This is the book value of the old turbine. Plus cost of the new turbine is 45 lakhs. Finally, you will get the answer. This will be called as the revised carrying amount of machinery. You will get 7156,840. Little above, minus, plus minus, this is okay, but nearly around this. There could be some differences because of rounding of errors. I also have a PDF prepared with the solutions for whichever questions you have. At the end of the class, I will maybe today or at the end of all the 5 days classes, I will share this PDF with you. Or today also, today itself I can share the PDF with you. It has the solutions for all the questions. And these are the suggested solutions from wherever I picked up the source. MTP means from that MTP, this is the suggested solution. Okay, this question done. What have we covered now? We have covered subsequent costs. Costs that are incurred after the asset is put to use. I told you that there are two branches to this. One is replacement cost and the other would be inspection cost. Any major inspection, even that cost can be capitalized. The way you deal with major inspection is the same as the way you deal with replacement cost. What you will do is, whatever is the cost of the item, cost of the asset, minus the book value of previous inspection plus the cost of new inspection, we will add and arrive at the revised PPE carrying amount. Same as what we did under replacement. The standard also talks about day-to-day servicing. Day-to-day servicing cost, can you capitalize along with PPE? Means answer is no. This is only to maintain the asset. It cannot be capitalized. After subsequent cost, next comes what all we have just seen so far. Initial recognition and measurement is over. Now we will move on to subsequent measurement. Subsequent measurement means what? Measurement on every balance sheet date. How do we measure the PP on every balance sheet date? That is only what we discuss under subsequent measurement. For this, the standard suggests two models. First one is the cost model and the other is revaluation model. Cost model is what you already know. You will have to capitalize the asset at cost minus any accumulated depreciation. This will give you the carrying amount to be shown in the balance sheet. This you are already aware of. Revaluation model tells we will go in for revaluing the asset, revalue the PPE on every balance sheet date. If you are going to do a revaluation on every balance sheet date, it means the entity is following revaluation model. The question comes, if I follow revalue model for, let's take building, I have multiple assets, building, machinery, furniture, and okay, we will deal with these three items: building, machinery, furniture. If I follow revaluation model for building, should I follow revaluation for all the assets? Answer is not necessary. Revaluation is to be done class by class basis. If I use revaluation for building, all the buildings should be done by revaluation. Not necessary that all the assets should be done by revaluation. I can choose cost model for machinery, cost model for furniture. When I tell class by class basis, it means, say we are having furniture in our office. Some furniture I do by cost model. For some furniture I do by revaluation model. Is that allowed? Answer is no. If I do revaluation for furniture, all furniture only revaluation. You can't choose two different models for one category of asset. But for all the categories of asset, same model, not necessary. I can choose class by class basis. In this context, there is a question in the study material where they tell you that the asset under discussion was building in that. They tell that this entity is having two types of buildings. One is the factory building and the other is building that is used for administrative purposes. Factory building, the way they use is different because of the location is different. The nature of use is different. Administrative buildings also location is somewhere else. Both are located in different places. The way they are used is also different. In this scenario, the question asks you, can we use cost model for this and reval model for this? Two different models, is it possible? That's the question. Do you remember reading this question from the study material? No idea? Entity A is a large manufacturing group. It owns a number of industrial buildings, such as factories and warehouses and office buildings in several capital cities. That's what I meant by factory building and administrative purposes. They have some building. The industrial building are located in industrial zones, whereas office building is located in central district of the city. Entity A's management wants to apply reval model to the subsequent measurement of office building, but it will continue to have this industrial building as per cost model. Can they do it is the question. Answer is yes, because nature of usage is different. Class by class basis, there is one line told about class. Yeah, here. A class of PPE means we are grouping the assets of similar nature and similar in use. Similar nature, similar use. Office building versus factory building, are they used similarly? No. The nature is also different because location is in two different places. So they are of different nature and different use. Hence, we can have one model for factory building and another model for office building. That's the answer for this. So the model should be class by class basis. Under subsequent measurement, that's the first point I want you to understand from a question viewpoint. Next point which you should understand is, how do we deal with revaluation model? How do we do accounting under this model? Suppose we go in for revaluation, there could be two options which are possible. Option 1, there is an upward revaluation which happens, or option 2, there could be a downward revaluation. When at an upward revaluation, the journal entry which we pass will be PPE account will be debited. Whatever is the increase in the value of asset, can we take it to P&L account? Answer is no. We will have to keep it in a separate place called reval reserve will get created. If it is a downward revaluation of asset, PPE will get credited because you have to reduce the value of PPE. Corresponding debit will be P&L account. The rationale behind this is conservatism. Recognize any possible losses, but do not recognize any possible gain. Any anticipated gain cannot be recognized. That's why we keep it in reval reserve. The standard goes further and tells this is about first time revaluation. Then we have to understand about subsequent revaluation. How do we account for subsequent revaluation? That depends on what did we do in the first time revaluation. So, first time revaluation was upward revaluation. And now also upward revaluation. First time upward and again also upward revaluation. How do we record this? Journal entry upward means PP will be debited. Corresponding credit will be to reval reserve account. Say first time was upward revaluation and now there is a downward revaluation. First time upward, we would have created a reval reserve and now there is a downward. If there is downward, PPE has to be credited. Corresponding debit, you will not directly take it to P&L. You will debit it to reval reserve to the extent there is a reval reserve, and anything beyond that will be taken to P&L account. Next, case B. First time is downward revaluation. Now also downward revaluation. How do we deal with it? We understand. First time we had done a downward, which means we took it to P&L. Now again it is downward. Downward means PP will be credited. That we will fix first. Corresponding debit will go to P&L only. There's no change in that. First time was downward and now upward revaluation. When there is an upward revaluation, PP has to be debited because it is an increase in the value of the asset. Corresponding credit will go to, generally upward means we'll take it to reval reserve. But we've already done it through P&L. So the credit will go to P&L to the extent it was debited earlier. And anything balance will be taken to reval reserve. This is about the revaluation model. We will do a question on this model, this principle. Okay, question number 9. XYZ Limited provided you the following information for the year ended 31st March. Subdivision 1 we are reading. Carrying amount of a property at the end of the year is 2,16,000. 2,50,000 is the cost minus accumulated depreciation of 34,000. That's how they arrived at 2,16,000. On this date, property was revalued and deemed to have a fair value of 1,90,000. There is an upward or downward revaluation? Downward. How much is the downward? 26,000.
26,000.
Okay, remember that in your mind. Continue to read. Balance and revaluation surplus relating to previous revaluation gain for this property was 20,000, which means they've already created a reval reserve. Can you please write the journal entry quick? What will be the journal entry for this downward revaluation? First fix PP. It's a downward revaluation, Vikram. So PP will be debited or credited? Credited. So 2 PPE. Debit will be to reval reserve to the extent it is available, 20,000. The balance 6,000 will go to P&L. Okay. So this principle we are through with. The suggested answer also I'll show it to you. You have to write some amount of provisions also. You will have to tell that when there is a reval reserve already existing, any downward revaluation should be first netted off against the reval reserve and only the balance should be debited to P&L. The question shows this 6,000, how do they arrive at 20,000? Sorry, 26 is the total loss, minus it from reval reserve, 6,000 is the net loss. The suggested answer is not showing journal entry, but I would tell that it's better for you to pass a journal entry because it is easy for you to explain as a journal entry to the examiner. If you write statements, maybe some will be able to express your understanding, some may not be able to express clearly. So write a journal entry that will be clear that you have understood the concept. Okay, I'm done with this revaluation model. I'm moving to the next concept under AST. I will move to depreciation. Cover all, yeah. There is disposal of PP. I'll come to it afterwards. I want you to remember what is depreciation. There is a sentence. I want you to know that sentence. The one who's, what is your friend's name? Sasi Kumara. I can't see your face, only Sasi Kumara. You're totally hidden. Either you move this side. I don't know whether you're listening, responding, understanding. I cannot even see your face. And it's okay, Vikram. You be with us. What is depreciation? Depreciation is a systematic allocation. It is a systematic allocation of the depreciable amount of PPE over its estimated useful life. This is the meaning of depreciation given as per AS 10. Depreciation is, it is your allocating. Allocating means you are splitting, dividing. You are dividing what? Depreciable amount of PPE. What does depreciable amount of PPE mean? Depreciable amount means cost minus the residual value. To best remember this sentence, can you recall back what is depreciation as per straight line method formula?
Straight in.
Depreciation is equal to straight line method.
Cost minus residual value divided by useful life.
This formula is written as a sentence. What are we doing under straight line method is we are dividing this over its useful life. What is cost minus RV? Technical word for it, depreciable amount. So what we are doing in depreciation is we are allocating or dividing depreciable amount over its useful life. And this allocation that you're doing, you cannot do it on random basis that in first year I'll allocate 30%, second year I'll allocate 10%. You can't do it random basis. You'll have to do it on a systematic basis. So depreciation is nothing but you are systematically allocating depreciable amount over the useful life of the asset. Suppose you're answering any question on depreciation, please write this sentence. Next one. For computing depreciation, what are the factors required? There are 4 factors required. First factor is cost. You recall back the formula for depreciation and the straight line method. It's easy for you to know the factors. Second factor is residual value. Third factor is useful life. And the fourth one, you should know what method to use for depreciating. The standard tells that you can use 3 methods the standard suggests. One is straight line method, other is WDV method, and the third one is production units method. If you are from the foundation stream, you would have come across production units method in the foundation syllabus also, where we will allocate the depreciable amount. Allocating depreciable amount means cost minus RV will be divided by total life. But total life we know as years. Suppose we write total useful life in terms of units, we will be using production units method. No question will be asked to you on production units method. Mostly questions will only test you on these 2 methods. So there is no study material question nor any RTP on production units method. Okay, I will write down the, can we just repeat the factors? Cost, residual value, useful life, and depreciation method. All of these 4 can also be called as accounting estimates. Every year end, we will have to check whether these estimates are correct or is there any change in the estimate. Suppose at the beginning of the, that is when we put the asset to use in 2020, we had estimated that the useful life of this asset will be 10 years. In 2025, we find out that the asset can be used only for more 2 years. So it means that our previous estimate was 10 years. We have revised this estimate. Any revision in estimate will be accounted for as per accounting standard 5. And this will be accounted for prospectively. There is no retrospective application, only prospectively. What do I mean by prospectively? We will do a question and understand it better. There is a sentence in the standard. I don't want to tell the sentence right now. We will do a question. I will pick the question which is falling under this. Question number 8. We will solve all the 4 subdivisions. The question is on depreciation calculation, different model of depreciation calculation. If possible, we will do it in the calculator itself. Again, I repeat, if you want to know the suggested answer, anyway, I'm going to share it with you, the PDF file, which will have the provisions also. Machinery purchase for 10 lakhs on 1st April 2015. Residual value after 5 years that you're going to receive is 10 lakhs based on 2015. Yeah, 10 lakhs. There's no typo error. What will be the depreciation for this? What is the formula for depreciation? Cost minus residual value divided by life. What is cost here? 10 lakhs. Residual value 10 lakhs. 10 minus 10, 0. Depreciation is 0. Okay. They tell you that the company considers residual value based on the prices prevailing on balance sheet date. The entire sentence should be understood as the residual value is equal to cost. Therefore, there is no depreciable amount. So, depreciation is 0. Next one. Land for 50 lakhs. No depreciation on land. Only buildings are depreciated. Next one. Machinery is constructed for 5 lakhs for its own use. Useful life is 10 years. Construction is completed on 1st April, but the company does not begin using the machine till 31st March 2020.
Available.
From which date will we start the depreciation? From the date as it is available for use. Available for use is from 1st April 2019. Depreciation will begin from that date. Entity should begin charging depreciation from the date machine is ready to use. The fact that it was not used is not relevant for depreciation. Whether you use it or not is not relevant. Okay. The next subdivision. Machinery is purchased on 1st April 2017 for 50,000. Useful life is 5 years. Residual value is nil. On 1st April 2019, how many years over? 2 years over. That time we find that the asset can be used only for further 2 years. Now I will explain what do I mean by that prospective word. The date of change in the method of depreciation, in the useful, whatever the date of change in the accounting estimates is 1st April 2019. The asset was put to use on this date. From here to here, 2 years over. We have to first find out whenever there is a change. The step number 1 will be find out what is the carrying amount of the asset as on the date of change. Whether useful life changes, residual value changes, method changes, whatever changes. Find out the book value or the carrying amount of the asset as on the date of change. Can you try next to Sasi? What is your name? Santosh. Can you quickly tell me what is the carrying amount of the asset on the date of change? 30,000. 50 minus, 20,000. 30,000 is the carrying amount as of the date of change. Now, step 2. Compute the revised depreciation based on whatever is the revision done. Now, useful life is 2 years. So, 30,000 divided by 2, 15,000 will be the revised depreciation. And step 3, find out what is the revised carrying amount. That will be 30 minus 15. Anyway, that 30 minus 15 is not being done because the question only asks you calculate depreciation. That's why the question stops with just 15,000 computation. Okay. Now, question number 9, second subdivision, we will do. First one we've already tried. You are required to calculate revaluation loss as per AS 10 and give its treatment in the books. An asset that originally cost 76,000 and accumulated depreciation of 62,000 was disposed of during the year for 4,000 cash. So this question is on disposal of an asset. You are required to explain how the disposal will be accounted for. I will just take you through the provisions of disposal, then we will come back to this question. The disposal, all the provisions of PPE are through. Disposal of PPE, else I can tell it is a sale of PPE. If you are used to writing or telling that a PP is sold, please make a correction to your sentence. Whenever you are writing in the exam, you will not tell sale of PPE, you will use the word disposal of PPE because the standard does not use the word sale. The standard setter feels that Sale is generally used only for inventories, and disposal will be used for PPE. Another correction to the vocabulary, some are used to writing scrap value. Please don't write scrap value, write it as residual value, because everywhere in the standard the word used is residual value. Nowhere the standard uses the word scrap value. Hence, you will also use the word residual value. Now, when an PPE is disposed of, first step is compute the carrying amount of the PP as on the date of sale. We will first find out the carrying amount of the PP as on the date of sale. Step 2, compare the carrying amount with sale proceeds of the asset. We can use the word sale proceeds, or we can use the word disposal proceeds also, but sale proceeds is also acceptable. Step 3, we will find out whether it is a profit or a loss on disposal. What I've written may not be clear, that's why I'm talking. When I'm writing, it's very, very difficult to write it this way. It's not very comfortable. Coming back to this question. First step, find out what is the book value or the carrying amount of the asset as on the date of sale. What is the carrying amount? Calculate in the calculator. 76 minus 62,000, 14,000 is the carrying amount. How much did we receive on selling the asset? 4,000. So we made a loss of 10,000. Please read also the provision which is there. It tells about how to treat that profit or loss. We should tell that the profit or loss should be either credited to P&L statement or debited to P&L statement whenever an asset is sold. If you write it in your own language also, it's okay. Here the language is pretty difficult. You can just write that the gain or loss arising on disposal of the asset should be debited or credited to P&L statement. In this case, it is loss, and from this you can draw an arrow mark and write this should be debited to P&L as a separate line item. It should not be as other expenses. It should be separate line item. It should be debited. Okay. We have covered whatever this handout covers is there on the page, first page. It is covering all the past exam questions. 5 past exam questions I have covered, and I have explained about the coverage, and it covers these 4 RTPs. Others means if I felt any other place where the question is any different, I would have included here. Yeah, I have done from my side. Whoever have come here, you would have also learned the standard at home. If you have any provisions which you want me to explain or anything beyond it, otherwise I will move to the next standard. Any question you have to ask me from the standard AS10, here or online, whatever be the case. Since online I'm not seeing it, any question you want to ask me, or we'll move to the next standard. When you studied, you have any doubts? Because I presume you would have studied only and come to the class. Okay, then I'm moving to AS26. AS26 deals with intangible assets. First of all, we will look at the definition of intangible assets. Intangible asset is an identifiable non-monetary asset. Identifiable non-monetary asset without physical substance. These three words are technical words used in standard. It is an identifiable. You should be able to identify the asset. If you are not able to identify any intangible asset, we will call that generally as goodwill. The standard deals with identifiable non-monetary asset. Non-monetary asset means anything other than cash and bank balance will be non-monetary asset. Identifiable non-monetary asset without physical substance. Say we are having the copyright of a movie. A motion film is called movie in general part. This movie, is it a tangible or an intangible item? It will be intangible, we will call it. Anything that is a work of art, knowledge, we will call that as intangible. But if I'm having a movie with me, how will I hold the movie with me? I will hold it either in some external drive or on a CD, or now you have it in the cloud also, but you have to hold it in a space. Leave cloud out. Say we are having the movie in a CD. CD I can touch, I can feel. So will this movie be called as a tangible or an intangible item? Intangible. Here the standard tells, the definition uses the word without physical substance. Then further the standard goes and tells there could be a possibility that something may have a physical substance. But you should check in that case which element is predominant. If the intangible element is predominant, is important, we will classify that as an intangible item, and if the tangible element is important, we will classify that as a tangible item. What do I mean by this statement? If I'm purchasing a computer, along with the computer, I also get an operating system software. When I capitalize this computer in the books, will I capitalize this as a PPE or will I capitalize this as an intangible asset? PPE. Along with the computer, you will get OS, you will get some basic software. But the purpose of purchasing the computer, is it for the computer or is it for the software? Computer. It will go as PPE. I purchase an accounting software. The accounting software comes on a CD. The purpose of paying money is for the CD or for the software inside? Software. So this will go as an intangible item. The word without physical substance should be understood clearly. That's why I gave example. Without physical substance does not mean it should not have physical substance. There could be, but the price that you're paying is not for the physical substance. The price that you're paying is for something which is inside that substance. I'm continuing the definition of PPE. It is an identifiable non-monetary asset without physical substance. It is held for producing goods, providing services, rental to others, or for administrative purposes. The same language which is used for PPE is used for intangible asset also. Not many questions are asked on the definition of PPE. Still, I just wanted to cover the definition. We will move to recognition principles. What were the recognition principles that we discussed under PP standard? Can you tell me, Santosh? 2 recognition principles. Initial recognition principles. First one, criteria. First one, it is probable that FEB will flow to the entity, future economic benefits. And second one,
And
cost can be measured reliably. Whatever recognition criteria that you saw under AS10, same criteria even for AS26. No change. 10 and 26 should be read one after the other because there's a lot of similarities between both the standards. So the recognition principle is the same. Coming to the measurement part. Here again, initial measurement is under discussion. The PPE can be either acquired by payment of cash. Under PP, the intangible asset can either be acquired by payment of cash. Under PPE, we learned 3 things. One was payment of cash, other was self-constructed PPE, third is the barter system. You exchange, you give one asset and get another asset. I call it as a barter system. Same 3 things are there even under this standard. Either you pay cash and acquire, or we go in for self-construction is not the word. The word used by the standard is internally generated intangible asset. Or it can be exchange of one intangible for another intangible asset. If you are paying by cash, whatever you paid, to the extent it is directly attributable to the asset, you can capitalize it. Example, cost are purchase price minus trade discount plus any non-refundable taxes, same language as we saw under AS10, plus any other directly attributable expenses related to bringing the asset to the present location and condition. There we saw about some dismantling charges that and restoration that will not compute, because intangible asset is not something which you're going to fix it in any place or dismantle it, not necessary. So that alone will not compute. Otherwise, it's the same as what under AS10. Internally generated IA, I will discuss it in some time, that there is some discussion to be done. Exchange of any IA should be recorded at fair value. Fair value, when you exchange, there is 2 things involved. 1, I'm giving one asset. 2, I'm getting another asset. You will record it at fair value of the asset that you give or fair value of the asset that you get, whichever is clearly evident. Same principles, no change. We will see a question. Question number 12. X Limited carried on business of manufacturing bakery products. Company has 2 trademarks, Sun and Surya. 1 month before, the company knows through one of the marketing managers that both the trademarks have allegedly been infringed by other competitors engaged in the same field. So someone else has copied our trademarks. We have 2 trademarks, Sun and Surya. Without our permission, some other bakery is also using our trademark. Infringe means that is the meaning. Sun and the strong case in regard to trademark Surya. X Limited incurred additional legal charges to stop infringement of both the trademarks. Both the trademarks have a remaining legal life of 10 years. How should they record this legal cost incurred? The infringement of this trademark, for that the company has incurred legal fees of, okay, the amount is not given, they've incurred some legal fees. Can you capitalize? That is the question. This question is on initial cost or subsequent cost. Subsequent cost. Initial cost criteria is probable FEB inflow and cost can be measured reliably. Subsequent cost recognition criteria is you should get some increase in FEB, much more than what you had got before. Only then you can capitalize. The same thing which we did under replacement and inspection cost, the same criteria is to be used here. Are you getting any extra benefit by spending this legal expenses on infringement of copy of the trademark? Or you are just spending it to maintain the trademark in your name? Maintenance. It's only maintenance. No new trademark is getting created. No new benefit is going to come. Hence, this cannot be capitalized. It should only be charged off to PM. You can go through the answer which is there here. Subsequent expenditure can be capitalized. I will read only relevant points from here. Subsequent expenditure can be capitalized only if it is expected to generate future economic benefits in excess of the originally assessed standard of performance. You can also read it and understand it as if the subsequent expenditure can be capitalized if there is an increase in FEB. You can write like that also. If there is an increase in FEB and cost can be measured reliably. In the given case, legal costs do not enable to generate any extra future economic benefits. So they are only to maintain them in the name of the company. They cannot be capitalized. It should be treated as expense. Okay, we will continue back into the standard few more provisions. I will now get into internally generated IA. Internally generated intangible asset. Now, when I did internally generated intangible asset, it means we are generating the asset, or I can tell we are constructing this intangible asset. We are ourselves developing this intangible asset. Self-developed IA. Whatever I am talking about, the discussion is valid for all intangibles other than goodwill. Goodwill is not part of discussion here. Why goodwill is kept out, I'll come to it later, but all intangibles other than goodwill. There is no question in your entire syllabus or RTP or goodwill specifically under AS 26. Though AS 26 deals with goodwill, it is kept out of questioning from your syllabus. So we are not going to discuss goodwill valuation itself. Only goodwill which you learn is as part of amalgamation. AS 14 also teaches you goodwill. That goodwill only you have questions. You don't have questions on AS 26 goodwill. Okay, this kind of asset, how do we do recognition? When do we recognize it as an asset? And how do we measure the cost? That we will try to understand. Any asset that you internally generate, that process will be divided into two phases. Phase 1 will be called as research phase and the other will be called as development phase. We all know right now there is a product in the market which is a bat. This bat is an electric bat which can kill mosquitoes. This was a new idea someone would have thought of at that point of time. Now it is very common. But at some point of time, let's take some 15 years back, someone would have had an idea. Whether this idea is workable or not, he did not know that time. So he would have tried to convert that idea into a product. till he was not sure whether that product is going to work out or not, we are into the research phase. Once he had some way, like now it is bad, let's take that time, he had designed this product as something like a square, not a circle, square. He had developed it, and then he had made it like a prototype, and he was testing this whether it is workable or not. When the test came positive, only then we will enter into development phase. Suppose that till the test keeps failing, which phase are we in? Research phase. When he tested it, it was okay, but to hold it in the hand, it was very difficult. So he was thinking of how am I going to design such that it's easy to hold. Probably after that he came out with this bat idea. All this happens during the development phase, and finally when the final prototype is ready, we will enter into commercial production. At what point of time can we start capitalization? The standard tells that whatever happens during research phase, it should only be expensed off, no capitalization allowed. Why? Because there is no probability that FEB will flow to the entity. We do not know whether the idea is workable or not. We do not know whether there will be a future economic benefit. So it should be expensed off. Development phase, whatever happens, can be capitalized as part of cost of PPE. Are you aware that there is some extra criteria given in the development phase? Have you learned? No, some extra criteria. Are you aware? What is your name? Ponmuli. But this you are aware that it can be capitalized. I'll come to the additional criteria afterwards. Because that is generally not tested in the exam. 5 criteria are there. I will see whether if it's necessary, I will talk about it. If not, it's not necessary. Even if you skip learning about it, it's okay. I will do a question and then come back. If you are able to understand the question, I need not explain the criteria. Okay, we are going to do question number 11. An enterprise incurred cost to develop and produce a routine, low-risk computer software. So it is a software development. It is an intangible asset. Completion of the program and design, phase 1, 25,000. Coding and testing for establishing technical feasibility, phase 2, 20,000. Other coding testing cost. Product masters for training materials. Duplication of computer software and training materials from product master, back in the product. After completing phase 2, it was established that computer software is technically feasible for the market. So when is the development phase beginning? From after phase 2 till phase 2, it is only research phase. What amount can be capitalized as software cost? Can you please add it in the calculator and tell me the number? Sasi, can you tell me, Sasi, after adding? Yes, Sasi, what is the number? 25,000, 20,000 cannot be added. I will tell that. You tell me out of the remaining 5 numbers, which numbers can be added? Ponmuli, what is the cost for Ponmuli? Which all numbers you can add? You tell me the numbers. 42,000 can I capitalize? Yes. 12,000. 13,000.
13,000. 40,000 into 2,000 units.
No, 40,000 is after. It's for 2,000.
And 11,000.
So all of it can be added? All of it can be capitalized? Yes? No. No. duplication of computer software and training materials from product masters. That one is where the training materials are already ready. Software is already ready. You are only duplicating it. The software is ready to use at this point of time. You are only duplicating it, means this is expenses that are incurred after the asset is ready to use. This cannot be capitalized. You are only duplicating, as in you are already having a software for the purpose of backup. You're taking another copy of the software and keeping with you. The backup cost you cannot capitalize, or the duplication cost cannot be capitalized. Next, packing the product. Packing cost also will not be allowed to be capitalized. Training cost. This is training materials you're preparing. It's different from training cost. Suppose the question tells we are incurring some cost on training the staff for the software, not allowed to be capitalized. If you are making training materials, you can capitalize. This is the answer. I will read whatever is the relevant points. Cost incurred for creating the software product is divided into two phases, research and development phase. Whatever cost is incurred till the asset recognition criteria is established will be expensed off. After the asset recognition criteria established, you can capitalize it. 45,000, which means addition of 20 plus 25 plus 20, it is incurred before the technical feasibility established, so it should be expensed off. Cost incurred after feasibility established till the time until the time when the product are some mistake in the sentence wording, till the time product is ready to put to use. That's how the sentence should be worded. Can be capitalized. 42 plus 12 plus 13 can be capitalized. Duplication and packing are incurred after development phase. It is not part of development. You've developed it, that's why you're duplicating it. That will be expensed off. Duplication and packing cost should be expensed off. Okay, we are just left with the amortization part. I will take through the amortization. The meaning of amortization is the same as what definition we have given for depreciation. What is depreciation? We wrote down, it is the systematic allocation of depreciable amount over its useful life. Same thing here, amortization is systematic allocation of depreciable amount. Amortizable amount, there's no word like that. That's why depreciable amount over its useful life. Factors required for amortization: cost, residual value, same word. Third was useful life. There is a change in the terminology for that. Factors, first is cost, second is residual value. Third one, the word used is not useful life. You will use the word amortization period. The meaning is the same. Method, you will tell amortization method, not depreciation method, amortization method. Any of these three things can undergo a change, which means there can be a revision in the estimates. In case there is a revision, it should be accounted for prospectively as per AS5. Same words as used in AS10. Under AS10, we learned about subsequent measurement, where there was a cost model, reval model, all that not there in AS26. It is only for PPE that model is given. For AS26, there is no concept of revaluation model. there could be a change in any of this accounting estimate, it should be accounted for prospectively. We will just do one question on this one. Question number 10. We will do second subdivision first. Company has developed a know-how by incurring expenditure of 80 lakhs. Know-how has been used by the company since 1st April 2018. Its useful life is 8 years. Company has not amortized the asset till 31st March 2024. Is it necessary that you should amortize the asset from the date it is available for use? Yes, it is compulsory that you should amortize. The company has made a mistake by not amortizing. So, in which year are they are right now? 31st March to 2024 means how many years are over?
6 years.
19, 20, 21, 22, 23, 24. 6 years over. What is the amortization for 6 years in this case? 60 lakhs. 80 lakhs is the cost.
40,
8 years is the life.
40.
So 60 lakhs should have been amortized. 60, no? 80 lakhs is the cost. Divided by 8 years. 10 lakhs is 1 year. 1 year 10 lakhs, 6 years 60 lakhs. This 60 lakhs they are splitting as current year will be taken as amortization. Any prior period expenses will go as prior period item. If you remember learning AS5, they talk about prior period items. So prior period item will go separately and this year's amortization will go separately. Okay, we will take up this last question. One point I forgot to talk about amortization. Yeah, this one. There is something more to understand in this case. Factors. Something more to understand. Under AS 26, there is an additional guidance given for amortization. That additional guidance is, if you do not know the residual value, you should assume the residual value to be 0. If you cannot ascertain residual value, it should be assumed to be 0. That's the first assumption you should make in the absence of any other information. Next, the standard tells that there is a reputable presumption that the amortization useful life of the IA cannot exceed 10 years. It is a reputable presumption, means you can take more than 10 years, but you should be able to prove that why you are taking a life more than 10 years. Otherwise, it cannot exceed 10 years. That is the second assumption which the standard tells. Third, if you are unable to find out which method to use for amortizing an intangible asset, standard tells that you should use straight line method. These three are assumptions given by the standard. If you think that you want to use WDV, you can do it, provided you are able to prove that why you are using WDV. If you are unable to decide which method, you use SLM. If you are unable to decide what is the life of PP, 10 years. Unable to decide what is the residual value, assume it to be 0. These are the three assumptions which standard tells. Last question. In the following cases, record journal entries for amortization in the books of Hughes Limited. Company has acquired patent rights for 340 lakhs. Estimated life is 4 years. Amortization was decided in the ratio of future cash flows which are as under. You will have to decide what is the amortization which will go. Are you going to follow straight line method? No. WDV method? No. You are going to amortize the asset in the pattern of the cash flows. based on the cash flows. Can you please, yeah, proportionality to cash flow. Can you please work out? You will write it as, you will present the answer as a table. What was the study material done? Study material, not very clear presentation. We will show it like this. Here, cash flows, computation, amortization. Here, 1, 2, 3, 4. Cash flows 140, 350, 280, 420. Total the cash flows. Comes to 1190. This is the total cash flows. Now we will do the computation of amortization. Total cost of the asset is 340 lakhs. 340 lakhs divided by 1190 into 140. Do it similarly for the other years. Done? What are your amortization figures for me?
40, 100, 80.
120. Now, which year depreciation is relevant for the question? Please read the year. The company acquired Patent Toys on 1st April 2022. We have to find out the amortization at the end of the year, 31st March 2024. So, which year amortization is asked? 22, 23 is 1 year. This is the year 22, 23 amortization. This is 23, 24. So, this is only the amortization relevant. 31st March 2024. So, can we just pass a journal entry for this? Amortization account debit to patent right. Amortization is an expense, it should be debited. Patent right reduces in value, hence it has to be credited. 100 lakhs. If you see, just see the suggested answer, that's the journal entry. They've given only the entry for the year ended 31st March, 100 lakhs, and then they make a transfer to P&L. Because it's a nominal account, they transfer it to P&L. Okay, we will